Not so long ago, banks were at the forefront of large corporate lending. But the ripple effects of the 2008 global financial crisis have meant the biggest players in the sector are changing.
Banks are retreating from markets today because of regulation, and pension funds and sovereign funds are filling that void. So in that case, the de-bankification is a function of these long-term investors filling a void left by banks. They are transforming the economy.
I'm Alex Abchek. On this episode of Absolute Returns, scholar Ashby Monk explains why he thinks institutional investors have the power to move markets like never before. Then, we talk to AIMCo's Jonathan Braams about a relatively new space to invest in a sector that's as old as civilization.
I think the bottom line is that farming is challenging, right? You have volatility in prices, you have volatility in yields, and you have volatility in costs. I think taking a long-term approach on behalf of our clients that have long-term time horizons, it really allows us to ride the cycles of different yield years, different cost years, different price years.
Welcome to Absolute Returns. $140 trillion. That's how much it's estimated that institutional investors, like sovereign wealth funds, pension funds, and endowment funds, have under their management today. Ashby Monk says their capital can change entire industries, and sometimes even the course of a country's development. Ashby was born in Edmonton and is now based in California, where he's the executive and research director of the Stanford Research Initiative on long-term investing. Ashby, welcome to the podcast.
I love being here. It's fun to chat with you and maybe to chat with the people of Alberta.
It's great to have someone with roots in Edmonton join us on the podcast.
I'm hoping to get back up there in June and see everybody. Thanks for inviting me on. I'm honored.
I'll dive right into it and start by asking about your academic career, where you've spent that entire time studying institutional investing. Why are you so passionate about it?
Yeah, a lot of people ask me that question. Why do I want to study pension funds? It's not to be the center of the attention at a cocktail party, I'll tell you that much. But the reality is, this is where the risk capital is coming from in our modern system of capitalism. These institutional investors with their $140 trillion, I often joke, they put the capital in capitalism today. And yet many researchers are not studying these organizations. There are no schools of investing in the way that we have business schools, but these organizations are not businesses. Institutional investors, they're often big, long-term investors plugged into some promise that society is making, either to deliver a pension, to fund a university, to manage some insurance. They often tie their origin story back to a government, to a sponsor that is trying to meet some social welfare promise. And so in my view, they merit unique attention. That's why I focus on them.
You said a lot there. I want to unpack it in a couple of different places. It's interesting when you do talk about institutional investors. I've heard you say a number of quotes and terms that have really stuck with me. When you talked about they put the capital in capitalism, I've also heard you say that they are the face of capital today. Is that just to do with their size? Is that why you say that?
They are big. With 140 trillion, that's bigger than global GDP. That's bigger than the global market cap of companies around the world, public companies, I should say. So they are big. And when they are the face of capitalism, I do mean that size carries huge influence over the system. But actually, I mean they are the base of that system. So we often have my students asking me, aren't venture capital funds, aren't mutual funds, aren't private equity funds the origin of all of this capitalist activity? But if you trace their capital comes from these pension funds, these sovereign funds. They're investing through venture capital funds and private equity funds in order to achieve their objectives. And then it's the mutual funds and the real estate investors that are often for-profit entities operating out of financial centers like London or Toronto or New York. Those are the entities that we think of as the face of capitalism. But actually, it's another layer, call it down.
And as these pensions and other similar asset managers have grown over time, we know that they make plays obviously in public markets and private ones. I'm just wondering, in your opinion, what markets are these asset managers having the biggest impact on?
They are transforming the economy. So by that, I mean, banks are retreating from markets today because of regulation, and pension funds and sovereign funds are filling that void. So in that case, you are seeing the de-bankification and the private credit marketplace that's emerging with pension funds investing in private credit is a function of these long-term investors filling a void left by banks. I wouldn't say that's a profound effect on the world, but it's an interesting outcome that these long-term investors are filling the void. In terms of the effects that they can have on the built environment, on timberland, on agriculture, it's quite a significant impact. When I started as an academic, infrastructure was just emerging as an investable asset class. And so the rise of pension funds and other long-term investors investing in infrastructure allowed governments to build things that they might not have otherwise built through public-private partnerships, even through privatizations in some geographies. You are seeing these long-term capital providers stepping in, providing their capital, and building toll roads and ports and energy. We have all these different assets that I would suggest exist because pensions were looking for a certain type of asset to invest in. And infrastructure or private equity or real estate are particularly appealing to these long-term investors.
And what's been the reaction to some of those changes from other players or stakeholders in that space when pension funds and sovereign wealth funds and others came in? Was it always welcome or thought that this will automatically be a good thing? Or was there friction when that capital was starting to come from somewhere else than people had been used to?
There's always confusion and questions around private investors coming into what some would view as a public good or even a government asset. But by and large, the entry of these investors into infrastructure or into sustainable energy like solar, wind, hydro has been seen as a positive because they are bringing capital that wouldn't otherwise make it there. And so on the one hand, yes, they are bringing kind of the capitalist commercial mindset to these assets, which may be a good thing in the sense that they're getting projects done faster, on budget, et cetera. But also they're unlocking capital that might never have made it there. And it's not just for infrastructure, it's also for development. You're seeing development organizations around the world, from India to Rwanda to Nigeria, establishing sovereign development funds that have a mission to attract pension capital into those countries. And so the rise of these pension funds has actually led governments to build entire strategies around attracting their capital into their infrastructure, into their industries.
But do you get pushback maybe from people who would say that an organization like a pension fund or a sovereign wealth fund that, like you said, puts the capital in capitalism, that maybe you can't reconcile that goal with also being there to execute social welfare objectives? I mean, how would you respond to people who say, like, you can't marry the two?
Yeah, we have to definitely hold a couple of thoughts in our mind at the same time. The first thought that we can never lose sight of is that these organizations, pensions in particular, exist for a very specific reason, and that is to pay pensions. Or if you're a university endowment, it is to support a university. That's why these pools of capital were often granted a beneficial tax status by governments around the world. They exist to solve a social welfare problem, and that is a charitable purpose, hence the tax designation. So when we're taking this long-term capital and seeking to invest in infrastructure, the logic of all of those investments has to flow back into paying the liability for which it's been set up. But that thought can exist in my head alongside the thought that says this long-term capital can think differently about how it generates that performance from a short-term investor like a hedge fund or a trading firm on Wall Street These pension funds, they are looking out 30, 50, 100 years into the future. And it's in that time horizon that we can begin to think about how do these funds generate high performance while making the world a better place. And that's really the work that I'm excited about as an academic, is to say, hey, we can create jobs and build infrastructure and make net zero real estate and deliver high performance and perhaps higher performance.
We're going to come back to my conversation with Ashby in just a moment, because his comments got us thinking about how industries can change over time. Take agriculture. It's long been a part of Canada's economic and social history. Today, agriculture and the corresponding agri-food business generate about 7% of Canada's gross domestic product. But farming isn't what it once was. Factors like climate change and population growth are affecting the industry. Another change is large investors are now involved in different ways. One example is in AIMCo's own portfolio, with an investment in Bonifield, an organization that owns 130,000 acres of farmland across Canada from coast to coast.
My name is Andrea Gruza, and I'm a managing partner at Bonifield. Bonifield is a farmland investment manager. We provide alternative sources of financing for farmers, but really, like, our tagline is that we support farmland for farming. So Bonifield's business model is to offer a sale leaseback to farmers. So we're working with Canadian agricultural operators across the country. They're oftentimes coming to us to see how they can partner with us to either free up capital that's already tied into their existing land base, or to acquire additional acreage in their areas, but not have to do all of it off of their balance sheet. So some examples of how we can do this is that we may be working with a farm family that's planning for succession, and maybe mom and dad are looking to pass the farm on to the kids, but you may have the situation where only one of the three siblings wants to farm. Well, how do you get the other two siblings some liquidity to inherit that farm, but still keep the farmland in the family for that existing sibling who's going to operate the farm? So what Bonifield can do is that we'll step in. We can acquire some of the acreage that farm family has. They use that capital to pay mom and dad for the farm, maybe pass on some of the liquidity to the exiting siblings. And then we enter into a long-term lease with the ongoing farmer and allow them to have access to that land. And over time, we'll oftentimes sell back to the farmers. So it's almost as if it's transition capital.
That was Andrea Gruza from Bonifield. AIMCo's investments also include assets like timberland, agriculture, and livestock, concentrated in North America and Australia. Jonathan Braams is a senior principal in renewable resources at AIMCo, and he joined me recently to chat about the portfolio. Jonathan, thank you for joining us.
Oh, thanks for having me.
Can you tell us more about some of AIMCo's most significant agriculture investments? What kind of assets are within the portfolio?
Yeah, absolutely. So when we think about agriculture, I think it's important to just go back a little bit. So we added agriculture formally to our mandate in 2016, where we just had timberland mandate that sat within the broader infrastructure and timberland group at the time. So when we think about agriculture, we think about it in two components: core agriculture and opportunistic. And core agriculture we define as being investments in row crops, permanent crops, and livestock investments. And they're generally land-centric investments. A couple examples of our two largest agriculture investments. One is a company called Lawson Grains. It's a grains business in Australia, entirely in the regions of Western Australia and New South Wales. There's more than 10 aggregations, and basically grows similar grains to what we grow here on the prairies, primary canola, wheat, and barley. And that investment we made in 2022, so we've held for about 2 years. Our second largest agriculture investment is also in Australia at this time, and that's one that we're just in the process of closing, and actually should closing today, which is exciting. And it's our first livestock investment in a company called Yugawalla Pastoral Company. And this is a very large aggregation of cattle stations in northwestern Australia in the Kimberley region, and it's about 135,000 head of cattle over almost 7 million acres.
Can you put that in perspective in any way? I'm trying to imagine what 7 million acres is, but I'm having a hard time sort of putting a marker on that.
Yeah, it's about the size of Belgium.
And is it unusual to have one owner for such a large piece of land and so many cattle, either in Australia or in other parts of the world?
Yeah, it is fairly unique. This was an aggregation over several years where separate stations were put together. One thing that really attracted us to Australia agriculture was the fact that it is less fragmented relative to developed markets like North America and Europe, for example. We saw in Australia that the average farm size tended to be a lot larger relative to here, which can drive operational efficiencies.
And can you break down for us why investing in agriculture makes sense for an institutional investor that has, a lot of capital and also really long-term horizons?
So I think, first of all, it's an interesting asset class because it has very low correlations to traditional asset classes like stocks and bonds. And there's a few different return components that make it interesting. So investing in land-centric agriculture, you always benefit from having the capital preservation of the actual underlying investment in the land. Then you can generate income from either leasing out that land or selling a commodity product if you tend to operate it yourself. And then also you can have long-term inflation linkage and upside from real price appreciation because land does tend to appreciate over time as the underlying income that you can earn on farm increases over time. And I think it's very interesting, and it's become more interesting over the last decade because where you used to be able to just either plant trees and sell logs or wood chips or plant crops and sell crops, there's been several other potential income streams that have come into play more recently over the last decade. And that's things like monetizing carbon, potentially doing conservation easements on your land, biodiversity projects on the land. And then having land gives you a lot of optionality to potentially explore partnerships with renewable power companies. There's been a lot of companies reaching out to explore using some of our farmland and our timberland for either renewable energy projects like solar, wind, even battery storage now.
You used the term land-centric there in terms of the type of investments that you're interested in making. Does that mean that when you're looking at a particular investment, it's more about the land itself rather than what's being produced at that moment?
Yeah, that's right. And I find one thing that we have the ability to do is change the land use if we feel that there is a better land use ultimately. And when we added agriculture to our existing timberland mandate, back in 2016, we're quite intentional to make sure that we had agriculture alongside timberland because we find there are some properties where it makes sense to, rather than just doing planting trees or just growing crops, we like to do both. And then really plant whatever makes sense based on soil type, based on climate, based on topography in that region or sub-region.
So living in Alberta, it's hard not to hear headlines about how tough farming can be when the weather doesn't cooperate, whether it's drought or cold snaps or heat waves. How does climate change factor into your assessment of risk for this asset class?
I think the bottom line is that farming is challenging, right? You have volatility in prices, you have volatility in yields, and you have volatility in costs. And we've seen kind of all of those play out historically. I think taking a long-term approach on behalf of our clients that have long-term time horizons, it really allows us to ride the cycles of different yield years, different cost years, different price years, and really have overall the good years will offset the bad years, will be fine. As far as climate change and how we're thinking about that with our investments, during our due diligence process, whenever we're buying a piece of land to grow a crop, we often look at what are the historical trends, what has happened with the climate over the last decades, and how might that continue into the future. So we usually think about temperature, we think about precipitation, and we think about the level of carbon dioxide in the atmosphere. And then we think, okay, if there are these certain changes, how's that expecting to change what we grow on the land? Can we still continue to grow that on the land? So that plays into our underwriting, and then we basically run scenarios on that basis. And we're constantly monitoring that for our existing portfolio companies to see whether things are changing.
With the way the portfolio is constructed, do you ever see perhaps a bad year for timberland, but a good year for olives, that kind of thing? Is there sort of a balancing out just also in terms of having those very different types of growing activities happening all within this portfolio? And is that conscious or intentional?
Yeah, very intentional. And I think that's something that's very important to us. And that's one advantage we would have over somebody who just had a single agriculture investment in a single region. So we really try to diversify by geography, by crop type, by end use market, by country, and by operator. And we really see that play out across the portfolio. So there absolutely are years where we have a bad year with one crop and then it's offset by a good year with another crop. Or it could be the exact same crop in one geography versus another geography. And not only on kind of northern, southern hemisphere.
The fact that we have investments across so many different areas really does speak to the scale that organizations like AIMCo or other institutional investors can bring to agriculture. How does this scale affect how we grow our food or our forests for that matter?
Yeah, I think that's one place where we can really add value to certain farms. We notice that in aggregating smaller farms into larger aggregations, we have been able to really drive operational efficiencies. So there are some instances within our cropping portfolio where the farms now are so large where it's several kilometers that the combine has to run before it turns around. And that really gives us the ability to just be more efficient relative to having these smaller block sizes, constantly having to move your machinery around from place to place. There's also significant benefit to operating at scale. We're able to get better use out of our machinery and able to use the best technology. So generally on our farms, we're using kind of the best in class seeders, sprayers, harvesters that are able to be most efficient.
So we were just talking a lot about technology and how it's really used in farming today. Obviously, so much has changed with farming, but there's such a long tradition of farming in places like Alberta or other parts of the world. What's the reception from local communities or local operators when institutional investors do purchase these assets?
Yeah, I think it's been mixed, to be honest. I think there's some farmers who would like to continue to see the fragmentation of family-owned businesses. But then I've heard a lot of positive feedback from our entry into certain markets, I think from a couple different perspectives. So one is, say right here in Canada, we work with a local investment manager whereby we look to purchase land and then lease it out to farmers. And that generally has been positive because we're working with large farmers and often helping them facilitate succession plan for them, because either the next generation does not want to farm or the next generation does want to farm, but they still need some type of transitionary capital to finance that transition. In a lot of cases, we can come in and we can buy a portion of the farm and then lease it back to them, and then that puts them in a better position, better capitalized to get new equipment, and then also we can help finance them to grow to become more efficient. In other cases where we're going in and operating, like in Australia, I think the way that we've gone about it has been received fairly positive. So there are some corporate farmers who aren't necessarily great stewards of the land and aren't active participants in the community. And that's not what we try to do. We try to be the exact opposite. We try to get into the communities. We try to have a lot of interaction with our neighbors. We try to buy our equipment and our inputs from the local farm store rather than outside of the community. And we even try to do things for our neighbors and host safety days. Like, we feel that as institutional investors, we can have industry-leading safety standards for our farms, and we can share what we learn from the safety side with individual farmers.
Last question is just about, you're the senior principal for this asset class at AIMCo. Is there any one story that you like to tell people about a site visit that you really were surprised that this was part of your day job?
To the point of Yugawalla, the most recent investment that we're in the process of closing now, a pretty unique site tour last summer there as well, just given the scale of that region and how remote it really is. So basically we had to fly up to Braams and then take a plane into the station. And then it's so large, it took us multiple days to fly around the different stations in a helicopter just to get a very quick overview of that asset. And it was just very fascinating to see the beauty of that region and then how everything operates in that part of the world.
What does the landscape look like there?
It looks like there's nothing there. And it's actually surprising because, you think 135,000 cattle, that's a lot. But it's such a large area that the stocking rates are generally quite low. We're there during the dry season, basically just feeding cattle.
Jonathan Braams, thank you so much for joining us today.
Yeah, thank you for having me.
That was Jonathan Braams, a senior principal with renewable resources at AIMCo. Now, this brings me back to my conversation with Ashby Monk. Ashby mentioned that a few decades ago, a lot of people wouldn't have thought you could invest in infrastructure like roads or power plants or farms. I wanted to find out more about how the investment landscape has changed and what Ashby makes of it. As a long-term watcher of this space, is there any industry or asset class where you were really surprised to see asset managers get involved, where you thought, nope, didn't see that coming. I didn't think that long-term investors would want to have a role in, for example, this industry or that. Do you have any specific examples like that?
One that's surprising now, I would say, is nature as an investable asset class. Nature would go under the guise of oceans, air, timber, agriculture, and the whole voluntary offset ecosystem. I see a lot of organizations taking nature very seriously. It almost feels to me like infrastructure did 20 years ago, where people were like, wait, you can own infrastructure? Like, I've got a bridge I want to sell you. Like, wasn't that a joke? And it's like, no, actually, people want to own bridges. We should have bought that bridge. It kind of feels like that right now with nature. You're seeing people literally going out and just owning biodiversity and holding it there because so many people have made net zero commitments in the corporate space. That has huge value to be able to translate that into offsets.
I can't help but ask, but do you think that it is a weird thing to want to own nature?
It's definitely a little bit counterintuitive to say we're just buying nature and preserving nature. But as an economist, I would say it's pretty great to assign property rights to these things and allow somebody to then protect that property. If we didn't assign the property rights to these people, would they be assigned to somebody else that wouldn't protect it? The truth is we need to protect it. And if this is a tangible outcome of the climate movement, then I think that's a pretty good thing. Conservation is not a new concept. It's just nature as an investable asset class is a new concept.
Ashby, just to wrap up, as we mentioned at the start of the interview, you were born in Edmonton, raised in San Francisco, have traveled the world. But you probably still know that Canadians like to feel distinct from their U.S. neighbors in a lot of ways. From your vantage point in California, are Canadian institutional investors unique in some way?
You know, I've grappled with this for a long time, and I'm going to test out with you a couple of ideas. First off, in Canada, we seem to trust our government more than Americans do. And so I think we, as a series of Canadian provinces with our Maple 8 pension plans, we assume the government can design sophisticated investment organizations that can have a global footprint and that can recruit, retain, and incentivize properly the talent to manage that capital. There aren't many places like that in America. There's a much stronger distrust of government. And I think that what comes with that is a lack of interest in empowering the governments to build truly sophisticated global investment organizations in the name of pensions. We have sophisticated pensions down here in the US, but they're often not global. And they definitely don't have the same compensation structures or tech budgets or data budgets as the Canadians. And so I think it is that Crown Corporation model. But then beyond that, I think there has to be that culture of having a little bit more trust in your government.
We could probably do an entire other episode about cultural differences. And you would be the perfect guest for that. Ashby Monk, thank you so much for joining us today.
Thank you so much for having me.
That was Ashby Monk. He's a professor at Stanford University. Ashby is also the host of the Don't Get Fired podcast, where he talks about how to pursue innovation in institutional investing and still keep your job. That's it for our second episode of Absolute Returns. I'm Alex Zabjek. Thank you for joining us. Absolute Returns is a podcast by the Alberta Investment Management Corporation. Don't forget to subscribe. You can find us on Apple Podcasts, Spotify, or wherever you get your podcasts. Until next time.